The broadcast is now starting. All attendees are in listen-only mode.
Hello, and welcome to today's webinar. I'm Nick Zulovich, part of the team at Cherokee Media Group and senior editor of Subprime Auto Finance News and AutoFin Journal. In today's webinar, Data Due Diligence, a three-pronged approach to proactive risk mitigation, we're going to learn more from Ann Holtzman of Allied Solutions and Jeremiah Wheeler from DRN. But before we get started, I want to go over a few housekeeping items for today's webinar. Please make sure you've dialed in using the phone number provided in your communication email, or you're able to listen via your PC speakers. We are recording today's webinar, and we'll make the recording available to you as soon as possible. You will be in listen-only mode for this webinar, but we will reserve some time after the presentation for a Q&A session. You can submit your questions at any time through the questions box on the GoToWebinar control panel. And if we aren't able to get to your question today, don't worry, because we'll forward it on to the teams at Allied Solutions and DRN so they can respond back to you directly via email. And lastly, if you have any difficulty during the webinar, please click on the hand icon to alert a member of our team. So with plenty of knowledge to share, let's get right to Ann Holtzman and Jeremiah Wheeler for our webinar. Ladies and gentlemen, please, the floor is yours.
Thank you, Nick, and welcome everyone for joining us today. Jeremiah and I would like to thank you all for taking time out of your busy schedules to spend some time talking about data and the due diligence and risk mitigation benefits of using data in a proactive manner. Allied Solutions and DRN have been partners for a little over 4 years. We continue to combine forces in the risk mitigation and auto finance industry to provide collective data that allows our clients to proactively manage their risk. Nick, if we can go on to the next slide, please. In today's market, even though we have a very strong economy, delinquencies continue to be an issue. Both prime and subprime recoveries are up, but overall delinquencies remain at a historically high level in comparison to just a few years ago. Delinquency rates for subprime auto loans more than 60 days past due have now reached a historical number at 5.8%. The percentage of auto loans over 90 days of delinquency rose in the first quarter, up from 3.8% the prior year and under 2% in 2015. So although loan volume has increased significantly, we are now beginning to see the uptick in delinquencies, which means there's more delinquencies and more vehicles and collateral that is necessary to be managed and located in a proactive manner. Next slide, please, Nick. Due to the 2017 catastrophe losses in the fourth quarter of last year, insurance-related losses for automobile are at record levels. Based on the damages from Hurricane Harvey, Irma, and Maria, the insurance companies have suffered significant losses, and as a result, those losses are impacting what they're paying you today on vehicles that you both lend on and insure. For example, repairable vehicles, severity for those have gone up almost 22% in less than 48 months, and 17% on damages such as hail and flood. As a result of that, the insurance companies are forced to look at the severity of the losses that they're paying to auto lenders and consumers and ensure that they're managing those at record levels. Total loss percentages on vehicles have increased from 16.9% in 2016 and is projected to be over 18% in 2018. Considering there are nearly 14 million auto accidents a year, the insurance companies are seeing total loss accidents that continue to escalate, and as a result are putting pressure on them in regard to both severity and expense. Along with increased driving, lower gas prices, the increase of distracted driving, and this major jump in total loss accidents, many lenders are experiencing a significant impact on their gap claim processing time and the accuracy and timeliness of gap payments. Gap claims alone have jumped 100% in both frequency and severity in the last 2 years. Distracted driving is leading to a lot of these increase in losses. Nearly 3,477 folks were killed in 2015 in 391,000 auto accidents. No insurance means that a repossession is definitely more likely. And so as a result, with those repossessions, will you be able to recover from insurance companies for the physical damage that's a part of these repossessions? At Allied Solutions, we track a little over 15 million automobile loans. And what we have discovered through our experience in the last 5 to 7 years is that 70 to 75% of all subprime and near prime claim recoveries occur because of a tracked insurance record. And if you are in the auto lending business in more of the prime borrower space, nearly 86% of the claim recoveries that will be effectuated for your institution will come from data from insurance tracking. Next slide, please, Nick. We've also seen significant demand in vehicle lending. Both 2016 and 2017 marked record levels of new auto loans. That doesn't necessarily mean increased profits, because those auto loans and the increased demand for auto loans have driven prices up significantly. The average cost of a new vehicle in 2017 was a little under $31,500, with an average used car sale price at $19,300, and average monthly payments that have increased in the last 12 months from $436 to $523. It is estimated in 2018 that the average new car vehicle price will exceed $33,000. As a result, this is putting significant pressure on consumers who have to make these higher payments and finance higher dollar amounts. In addition to that, the exposure that you, a lender, has in regard to vehicles that go uninsured is now significant. In addition to all of this has been the increase in leased vehicles. Due to the expensive prices and the expensive payments, leasing is at an all-time high. For those of you in the lending world, that does hurt you when it comes to liquidating repossessed vehicles. We have seen in the last 24 months continuous pressure that are forcing repossessed automobile collateral to lower recovery dollars at auction due to the competition of off-lease vehicles. Based on that, lenders are increasingly dealing with larger deficiency balances and consumers that once a vehicle is either repossessed or totaled, they continue to have a large loan balance that needs to be paid, but also at the same time need to purchase a new vehicle. All of this is pointing to the fact that you, like ever before, need to ensure that you've got proactive monitoring of your loan portfolios and that there is data-driven integrity that allows you to proactively manage and prepare for both repossession and total loss activity. Next slide, Nick, please. If all of this wasn't bad enough, we are also seeing increased loan terms, basically due to the price of vehicles and the fact that consumers need an affordable payment. In 2017, loan terms hit all new highs with an average at 69 months. 31% of all new loans now exceed 73 months, and 19% are expected in 2018 to go to 84 months in length. I laugh when I tell my two sons who are in their 20s today that the price and average car payment they have was what I paid for my first mortgage in 1997. 17.5% of all used car loans now exceed 73 months. These longer loan terms and much more depreciation front-loaded into these particular loans is putting pressure on products such as GAP and is also increasing the opportunity for borrowers to relocate, make employment changes, have financial situations occur, and skip because the length of time that they have to pay off a loan has significantly exceeded. Thus, the need for proactive data monitoring on your loan portfolio. Next slide, Nick. I spoke a little earlier about the fact that we are also seeing loan to value ratios that are much higher than even 2008. 89% of all prime loans will have an LTV that exceeds 100%. 113% of subprime loans have an LTV value greater than 116%, and 33% of trade-in units have negative equity finance as a part of the transaction. Off-lease vehicles are negatively impacting values at auction, and end-of-lease terms are causing repos to be devalued. All of this is leading to greater and more abundant deficiencies at the time of a total loss or repossession. And we know that many of you are struggling with that today. Next slide, Nick. I also wanted to make everyone aware of what's happening in the P&C insurance market as it relates to total loss, because many of you on the phone today have to deal with negotiations on total loss vehicles, whether it be on a lease or a loan portfolio. 1 in every 4 total loss valuations is inaccurate. In other words, the insurance companies, due to the pressure that they're experiencing in regard to the recent storms and the stress that it is placing on their organizations financially, is forcing them to go to a more automated claim handling methodology for total losses and not actually inspecting and cataloging the condition of the vehicle at the time of the total loss, leading to options, mileage, and other things being missed on the vehicle. In 2018, total loss accidents again are expected to exceed 18% of an insurance company's automobile collision and comprehensive losses. When you look at the number of vehicles then that are being totaled, which has increased, and the fact that 1 in every 4 is not valued accurately, thus more money is owed to you as a lender than is offered, different entities out in the marketplace are offering total loss assistance and valuation services to assist you, the lender, in valuating and negotiating your total losses to ensure that you are paid an accurate and timely settlement prior to releasing a letter of guarantee. Allied Solutions and other servicers offer these services because of the pressure both on their GAP product and your GAP product, as well as that GAP product written at the dealership, and in order to ensure that the appropriate settlement in regard to the total loss. In 2018, Allied has looked at over 21,000 237 total losses that have resulted in nearly 5,000 of those losses being labeled as inaccurate, and increasing recovery on those total losses for our clients by the amount of almost $1.6 million. Ensuring that your total loss is reviewed and accurate data is used to assess the total loss valuation could mean millions of dollars to your bottom line. Nearly $360 per claim in the subprime market is the amount of inaccuracy of the original total loss offers being produced by insurance carriers, and nearly $500 in 1 in every 4 claims is the amount of inaccuracy being produced today with insurance settlements on total loss. So as a lender, we are recommending, together with our partner at DRN, that you use data to ensure that your total loss settlements are accurate and that you're optimizing those recoveries for your individual lending institution. At this time, I'm going to turn the presentation over to Jeremiah at DRN.
Hello, everyone. Thanks for joining us today. Nick, you can flip to the next slide. We're going to kind of switch gears here and talk a little bit about opportunities for lenders out there and different size lenders. What we've been seeing in the market lately is, are a lot of lenders, especially in the top 10, are pulling back on riskier loans. They're getting some pressure from outside of their organizations and their shareholders to, pull back a little bit on subprime loans. And we've seen that happen over the last year. And subprime lending was 9.26% of new car loans versus 10.1% a year ago. So that is shrinking. However, that does create some opportunity for smaller lenders, buy here, pay here's, to come back into the fold. Also some, we're seeing a lot more debt flipping hands out there, and some files being sold, some charge-off portfolios being sold, as well as deficiency balances. So, what does that mean for all the lenders out there? I mean, I think it really opens up a new door for new markets. And, the biggest thing for us is how can we help lenders like yourself, mitigate the risks associated to riskier loans. And so for all the lenders that are picking up all that, all the slack out there that all the big dogs are cutting back on, how do we create a really good opportunity and a risk model for you guys? Next slide, Nick. So, I think over the last year or so, a lot of the conferences, a lot of the events that we've been going to, the solutions of throwing data at it, and lots of it is really all about, different self-reported information that borrowers have to self-report, like credit histories and work histories. And what we're doing is partnering with Allied and other companies out there, along with our lender partners, and trying to create better behavioral scoring models, better propensity to skip models around using LPR data and analytics to say, we've seen this customer very far away from the given addresses on the file, even the references that they listed on file. We're not seeing the car anywhere near there. It's 500 miles away. So the propensity to skip for this customer is a lot higher. And so how do you manage multiple data sets, multiple data vendors, along with, data vendors like DRN? And how do you figure out, what the best approach is to build your waterfalls to make sure that you're using it early enough in cycle that you can identify those hard to find accounts and those riskier accounts earlier in cycle? Next slide, Nick. So this slide here, lots of data, $611 billion a year is what, bad data costs U.S. businesses per year, $611 billion. So it's basically throwing a lot of data at problems, a lot of data at questions, and not seeing clear strategies from that is just a really big waste of an organization's time. And Allied Solutions has a great partner out there, and I'll let Ann and speak to that. But on approach, we are partnering with them as well, along with Allied Solutions, to help identify trends, risk trends. They have a massive data lake with a lot of different data in there. And if you want to speak to that, that'd be great. And then we can flip to the next slide after that. Yep. Can you guys hear me? I can't hear Ann.
Thank you, Jeremiah.
No
thank you for that intro. So On Approach data was recently acquired by Allied Solutions, really to combine the significant amount of data analytics that we already have, because we've tracked automobile loans since the early 1970s. With now tracking nearly 15 million auto loans together with mortgage loans, we've combined with On Approach, and we are working at building a significant reservoir, if you will, or data lake of information that combines numerous data analytics and the propensity and understanding of what a borrower profile might be to help indicate delinquency, early delinquency, the ability or inability of them to make insurance payments, the ability or inability of them to make automobile and mortgage payments. And we're very excited. We believe that beginning next year, we will be able to take these data analytics and proactive data mining through this lake, combine that with our insurance and loan tracking capabilities, and create some modeling that can show our lender clients exactly what loans will go delinquent and even at what time frame they may go delinquent, as well as combining that with some of our other data in determining the propensity and the ability to repossess collateral at a certain time frame or date. So we think combining that with insurance tracking exposures and then recovery optimization through partners like DRN, it is really going to change the industry and change tracking from simply a forced placed have to do to mining of data that allows our lender clients and other lender clients to proactively determine delinquency.
Yes, absolutely. And, that gets us right into our next few slides, actually, where we're actually breaking down the prongs or the approaches that we want to kind of talk about today. And Ann and I will both speak to some of these, and we can kind of jump in. And if you guys start to have any questions within the next few minutes, feel free to send those in to Nick, and we will try to get those answered as soon as possible. But first prong is really addressing the data spread. I mean, how many systems do you have to access to get answers? And do you have all of those systems tied into one system? And that's the beauty of On Approach and that relationship and solution that they provide with Allied as well as DRN, putting everything out there into a data lake and then being able to extract it in the right applications to measure how easy is it to get reports? Are you tracking the right data? And then of the data vendors that you're using, are you tracking the right data vendors that are providing the most value, or are you still just using a lot of different data sources and kind of, not really knowing where your value comes from or what the ROI is associated to each individual data set? That's one thing that we here at DRN have really taken a strong approach to whenever we approach a lender or whenever we're working with the lender. We try to make sure that we're proving the ROI on our data. We try to make sure that it's carrying its weight and that the lender is happy with the solution, is happy with the ROI, and also understands the metrics. So, we try to really wrap our arms around being a data set that provides value versus just a commoditized, additional data set. So, that last, go ahead, Ann.
Yeah, I was going to add, Jeremiah, too, as we all strategically navigate the industry, we're also doing our best those of us that have significant amounts of data to reach out to partners like DRN and to join forces with other partners that we know have meaningful data that would allow you to do business better, and more importantly, gain data that you can actually do some action on. It's great to have data, but if that data isn't actionable and is difficult to get, and you can't get reporting on it, and it's not with combined forces. So as a result, Allied Solutions may have significant data sets. Your insurance carrier may have significant data sets. You may have some data scientists inside your own organization. But our goal is to combine with best-in-class data companies so that we can provide you a complete solution and not have you having to piecemeal your data. So as all of this continues to unfold and mature, what we have and what we're trying to build together with partners like DRN is a one-stop shop for data needs that you can get reporting as needed, tracking as necessary, and then ensure that the data that is being provided, number one, is accurate, which is very important, is compliant, number two, and number three, allows you to generate actions that improve your company's performance.
Absolutely. Good points, Ann. Very good points. Next slide, Nick. So I think you go back one. Yes. So this is also, another first prong piece, correcting data decay issues. And I think, every one of the lenders out there experience this on a daily basis, especially in collections and recovery, as accounts flow through one bucket to another, because there's, no contact, no response from different methods that you've used to try to get in contact with your customers. So, 30% of people are changing jobs, which obviously, causes people to change phone numbers and addresses and everything else. And then we have, 50% of people changing car insurance, which is a point that Ann will talk about here in just a second. It's a big deal. And then, changing email addresses, which is not as big of a deal, obviously, but some lenders are very electronic in communication. And if you can't get in touch with your borrower through, 3 or 4 different means or methods, then it's important to look holistically at other data sets and other analytics and other tracking things to make sure that you know where your customers are, that you can at least recover the asset if it comes down to that. And so we can go to the next slide, Nick. Or Ann, you want to speak to that car insurance piece too? That's a big deal.
It's very interesting because those of my generation, and I can say it, I'm a 50-something, we know better than to change car insurance, because car insurance is, and just as homeowners insurance and business insurance, it's all a playing the odds for the insurance company. So those of us who are a little more senior in age also understand that having a good track record with insurance companies is important, because then your likelihood for premium increases or to have your insurance canceled, especially in light of all the catastrophe activity that we had last year, is important. However, younger folks, millennials, others, they, and those that have financial pressures specifically, they stop and start insurance on a relatively regular basis. And they also do a majority of their insurance purchasing online. Again, those of us who are part of the older generation, we probably bought from an agent. I still have an agent today, and I call my agent. Many of you on the phone are probably laughing about that right now, but that's why tracking collateral insurance is important, because the dynamics and the makeup of today's marketplace is significantly different, and the ease to purchase is different. as is their mindset around not purchasing a home and not thinking any big deal about having to return a car to the bank if they can't pay for it. So again, just another data set that allows you to find somebody or find collateral or know your exposure, because people normally may hide from you, phone numbers, addresses, etc. They don't hide from insurance agents who need to track them down, and you usually can find all kinds of information in the deck page of an insurance company policy. So again, just important to know how often people change these types of important risk management solutions for their own personal finances, and how important that is then for you when you need to understand your uninsured risk.
Yes, absolutely. Good point, Dan. And obviously you're over there, talking about me, a millennial on this side, and the one-click purchase mentality that we have. So yeah, it's very easy for us to go out and change auto insurance and not think twice about it. Rate shoppers are out there and they do it all the time. And so you get that flip in insurance, or some people that don't flip, they just quit paying it. So that's a huge risk for lenders out there. This second prong approach is staying ahead of the risk. I mean, obviously that first point, layering in risk protection from day one, there's a number of different things that you guys can do to layer that in. Obviously, one is insurance tracking. Two would be for files coming back or recoveries coming back. The credit, the post-claims recovery is a big deal. There's a lot of different things that you can apply to the process. And then, go beyond just the one-dimensional credit files. I mean, those things they're great whenever they hit because they're really, really good and the data is fairly fresh, but they're not refreshed that often and they're self-reported by the customer. LPR data and location data and analytics is definitely something that's not reported, self-reported. It's, a picture of the car as our cameras are driving around. And so we capture 160 million of those a month nationwide. And we will know whenever a car is away from where it's supposed to be and can help you flag that for higher risk. And just as Allied Solutions can do the same for the insurance piece when those customers are rate shopping around. And then obviously help to protect you when the customers get into an accident and they don't have the correct coverage or whatever else, the gap policies and everything else will come into play. We can go to the next slide, Nick, if you don't have anything on this one.
Yeah, one thing I did want to mention, Jeremiah, that
Okay.
As an insurance tracker, we've seen and of course force place a lot of insurance for prime lenders as well. But what we've seen is that it's pretty consistent that when a borrower decides that they can no longer pay for their insurance and they go from being in an insured status to an uninsured status, 90 to 180 days later, you will have that vehicle in a delinquent status as far as the need to repossess. So we do think that insurance tracking allows you an early indicator to delinquency and use that as one of these second prongs to proactively manage future delinquency.
Yes, absolutely. And then obviously the title of this slide is Rate, Recover, and Recoup. I mean, rating things from the insurance perspective is one thing, but rating it from a risk perspective overall and how it relates to that customer and what they're reporting to you. Obviously, looking at it from an insurance perspective, if the customer says they live in New York, but they really live in, or they say they live in Connecticut, but they really live in Manhattan, their insurance rate should be totally different. So there's a lot of fraud out there just in that realm. But more importantly, if they're really in Manhattan and you're sending agents to look for them or door knock agents or whoever to look for them in Connecticut, then you're never going to find them. So not really knowing where they're misreporting data is really important. So rating them from that perspective is crucial. And then getting the right data recover faster and effectively is really important. And then, securing the auto claim services after repo, like we said earlier on the last slide, is huge. And, leveraging the collateral protection services is really important as well. But putting together the third and final prong approach, Nick, if we want to go to the next slide, is kind of bringing everything together and creating the waterfalls and the strategies and working with your partners and your vendors, whether it be, DRN or Allied Solutions or other data vendors out there. We're happy to sit down and work with all of you guys to figure out the best way to increase what we do in the marketplace, which is auto lending in general. I mean, we'd love to be able to help mitigate enough risk that we can, provide auto loans to a large majority of the population out there in record numbers, as well as, make some money while doing it. So, Ann, if you want to add anything to this slide, feel free. I know you have a lot to.
Yeah, absolutely. I think the other piece as you look at allowing you to lend deeper and lend broader is, just expanding your risk management services so that you can do those things. And that could be recovering physical damage collateral after repossession. It could be optimizing gap claims that are being paid through dealership programs. It could be ensuring that refundable products get canceled in a timely and accurate manner and returned to offset deficiency balances. I think the other thing that's probably very important to mention here in mitigating risk is many of us on the phone today, including Allied Solutions, rely significantly on the repossession industry and those repossession agents out there today. So companies like DRN and Allied Solutions are trying to find and support that network and that cottage industry that's out there, because this year alone, combined with 2017, there will be 18% less repossession and recovery agents to service all of our business. And so the better that we can support that industry, give them analytics and data to allow them to be more effective and efficient, especially when many of them work on a contingency model. I think it's important for our industry and important for their industry. And just as a plug for that, I know many of us spend significant amounts of money on repossession activity. And I am urging our constituency and partners out there in auto lending to make sure that they are supporting those repossession agents and skip agents out there, because they haven't had a raise in a long time, most of them, and they're dealing with the same regulatory and compliance issues that we're dealing with. And so anything that we can do to proactively help them manage the industry and serve our industry, I think is at everybody's benefit, and of course creates, optimization of recovery proceeds once repossessed. A recent study done by Allied basically shows that for every 90 days that goes by in which a piece of collateral is not picked up, there's not only depreciation, there's also $482 of additional damage put on that vehicle. So again, just ensuring that we're doing all we can to send people in the right direction for collateral retrieval, I think is important, and also supporting that industry.
Absolutely. I'm glad you brought that up, Ann. That's probably the most important part of the prongs and the waterfall and the strategy and everything else. If we don't have the wreckers in the streets, we're not going to pick up a single car. So supporting those guys and treating the agents as if, it were a regulatory body or industry that's looking at you. I think, we pay really close attention to all of those things all the time, especially as lenders do, because, they're worried about getting fines and everything else, when in fact we should be paying equal attention to the repossession agencies out there and supporting them equally, if not more than. I think, the collections and recovery units as a whole tend to be the redheaded stepchildren of of the industry in terms of getting treated like with the last of expenses and the last of budgeting. And then, you know, if we got to cut something, we got to cut it from recovery or whatever the case may be. So it's really important to get the collateral back and make sure you're decreasing your deficiency balances, because if it's never found, then it's going to be hard times trying to figure out how to bail yourself out of that one. But very good point, Ann. And Nick, if you want to, we can go to the next slide. I think Ann mentioned a couple of points off this slide here a few minutes ago, but the proactively working to make sure your payments are being made, and you know, limiting the lending opportunities is not a strategy. So stop, you know, cutting what makes you money. If you're making really good margins on subprime business, you know, figure out a better way to manage the risk versus cutting the lending aspects of it. I think it's everyone needs a car, and we need to figure out a way to get them the car, but obviously get you the data that mitigates your risk. And any other points you want to add to this one? We're getting near the end, and we'll probably have to take some questions.
Yeah, no, other than just know that as you're monitoring your collateral, there are also claim types like diminution in value. You definitely have that on leases. Knowing when someone gets in an accident so that you can protect you, the lien holder, when insurance payments are being made. And then finally, just ensuring that you provide as much data as possible to those agents while they run those cars, so that they can locate that collateral and ensure that you get it returned to you as quickly as possible.
All right. Nick, we flip to the next slide, please. So this is our final slide. So we could take some questions from the audience, but you know, the final slide is just stay on the road to recovery optimization, using the products, managing risk, recovery data and analytics is really, really important. And as Ann said, us being bigger partners in the industry, along with the lenders being obviously everyone's biggest partner out there, you know, we need to provide the best data and analytics to our recovery agents in the field to help them better their businesses, which would obviously, the return on that for you guys is twofold, if not more. So those are really good points. Nick, if you would like, if we have any questions, we can start to take those now.
Absolutely, and great information from both Ann Holtzman of Allied Solutions and Jeremiah Wheeler of DRN. And if you have any questions, please use the questions box on the GoToWebinar control panel, and we will get to those. And it's just a reminder that we are recording today's session, and so keep watch of your inbox for a message containing a link to the recording that you'll be able to review some of the great information that both Ann and Jeremiah have shared with other individuals at your shop, so you could be sure to have the data due diligence, a three-pronged approach to proactive risk mitigation. And to start off our Q&A session, kind of a great starting point. Ann, we'll begin with you, and then Jeremiah wants to get your assessment as well. It's just, what do you see are some of the key data analytics that you use to proactively versus reactively determining if a loan may become delinquent? What are some specific data analytics and metrics that can be a portend of when an account might become delinquent? Ann, we'll begin with you, and Jeremiah, your perspective as well.
Great, Nick. Thank you so much. I think there's behavioral components that can, and there's some really good consumer models out there that take into account things like employment, travel, do they own a pet, you know, what are their hobbies, what types of things do they buy online. All of those data elements in a consumer behavioral scoring methodology can allow that proactive delinquency indicators. Definitely their insurance status and whether the collateral is insured or not insured will do that. anytime they have a significant life change event in which they're changing addresses, for example, is another good indicator that maybe that there could be a life change that maybe just needs a contact or a call out. So those would be three that I can think of, Nick. And I think more will come as we continue to mine this data lake that we're working through, and find out what other things actually relate to delinquency and delinquency indication. But those are the three I can think of right now.
Yes, and I can add a couple there. I mean, the data lake thing is a big deal, and the insurance industry was pretty far ahead, I would say, in creating a contributory database that all claims, P&C claims, go into. And it's not necessarily saying that State Farm can see claims that belong to Allstate and can see the customer information or anything like that, but using attributes from different claims, different loans, different things. If you think about it, the data lake aspect is really a big deal when you think about all these different banks and credit unions and lenders submitting their data into this lake, and then you're using attributes from it to figure out the best path or which loans tend to be riskier. And it's kind of that point earlier about going outside of the credit files data. So it's using more of a behavioral analytics, smart AI approach to figuring out what are all the triggers within each loan buckets that create higher risk. So using obviously location data and analytics is one of the key factors in there as well that is not self-reported. So that's all I have on that one.
The voices that you're hearing, that's Jeremiah Wheeler from DRN, as well as Ann Holtzman from Allied Solutions, our guest experts for today's webinar. Data due diligence, a three-pronged approach to proactive risk mitigation. And if you have a question for either Ann or Jeremiah, please use the questions box on the GoToWebinar control panel. And this next one, we'll hand it off to you first, Jeremiah, and then Ann will have you chime in as well, kind of putting yourself in the position of the skip tracer or the repossession agent. Just what do you see is some of the key challenges today in locating collateral with the environment that we live and operate in nowadays? Jeremiah, first you, and then Ann, just what are the challenges in finding collateral nowadays?
Well, I think the biggest challenge is cleanliness of data. Obviously, in the subprime world, borrowers tend to be a lot more transient. They tend to move around. They're renters typically more than they are owners of homes. So their data trails are fairly thin. So it's, in my opinion, it's getting accurate data out into the field and being responsive to data pattern changes within the life cycle of the collections activity or a defaulted account, instead of round robin it through the same exact processes over and over, where it's 15 days, 45 days to 60 days to 120 days past due, and you take a full balance charge-off loss. Instead of doing that, being able to analyze different data sets and getting the right data out in the field, because it saves the agents a ton of money, a ton of time. I don't think as lending institutions, with all of the different tools and data sets and data vendors at their disposal, should expect a repo agent to do skip tracing. I think it should be done, and the account should be clean and ready to go when it goes out, or have a third-party skip tracing agency do that. But the agents in the field that are driving the trucks and putting the diesel fuel in the trucks, they need to be running addresses that are clean, that are good, that are have a confidence score and a rating on there. That helps them find the cars faster and more efficiently, which will obviously create, less efficiency on the back end for the lender and the consumer. So that's, I think there are a lot of different regulatory issues as well out there that are being pushed down upon, the agents, that probably needs a release valve added to that. There are different compliance programs out there that different lenders are making all of their agents adhere to. And so agents are having to buy 2 and 3 and 4 different compliance programs in some cases, and I think that creates some issues out there as well. But like Ann said earlier, I think we just need to make sure we're focused on the repo agents that have to go pick up the collateral and getting them better information, and I think that will make us all better in the long run.
Mm-hmm. I agree, Jeremiah, and I think the other thing when you think about just difficulty, is just the mobile, how mobile our society is today. There's lower gas prices, so people are driving a lot more than they were. Your ability to, effectuate where you're going and what you're doing online allows for that mobility. And I think also just making sure that we're not putting these repo agents into any peril, and we're properly supporting their compliance requirements and not asking them to cut corners and making things more difficult to find. I also think through all of the online activity, through the sophistication of borrowers and pretend borrowers out there, there's a lot of also fraud in lending today that we probably didn't have to this degree 5 years ago. And so when these folks work on consignment and they then turn around and find out that the loan is fraudulent, that's a lot of activity and work on these agents. And so having some of those fraud indicators and scrubbing for fraud when you're actually underwriting the loan or accepting the loan, I think can be very helpful to the repo agent on the back end.
Again, the voices that you're hearing, that's Ann Holtzman from Allied Solutions, along with Jeremiah Wheeler from DRN, our guest experts for today's webinar, Data Due Diligence, a three-pronged approach to proactive risk mitigation. And as we continue on with our Q&A segment here of our webinar that is being recorded, so please be sure to watch your inbox for a link to the recording so you can go through this great information again later. And we'll begin this question with you, and then Jeremiah, if you'd like to chime in as well. During the earlier portion of the presentation, you discussed the ramifications of hurricanes and other weather events, and thankfully here already this summer there was a tropical storm that thankfully got steered out to sea already this summer, but certainly it'll be intensifying as hurricane season goes along. But how can finance companies quantify their exposure to a potentially catastrophic weather event? What suggestions might you have as far as how they can gauge the potential risk that they're carrying to a weather-related event? Ann, we'll begin with you, and Jeremiah, if you'd like to chime in as well.
Yeah, so here we are again in the midst of hurricane season, and it's not just hurricane events though. Significant hailstorms in parts of our country, floods, wildfires. There's a myriad of different weather-related catastrophe events that occur where a part or a portion of a lender's portfolio can be badly affected. And so first and foremost, I think it's understanding your geography and where you're lending and what events occur there, and ensuring that, again, the addresses are correct where the collateral is, the borrower is where the borrower says they're going to be, and also is that collateral insured or not insured against a catastrophic event. I think second of all, inside a lending institution, just understanding if there is a weather event, you're going to get in line behind a significant number of borrowers who have to file claims. And so keeping something proactive in front of your borrowers around reminding them during catastrophes that it's very important to report the claims timely to their insurance company, and that they use the diligence to protect the collateral if there's a weather-related event, like tarping it or securing plastic, etc., is important. I think also knowing what your exact exposure is. So if you have an insurance program or a tracking program, FEMA will send out to insurance companies and trackers the zip codes of any catastrophic event that has in excess of $1 million of loss tied to it. They will heat map it for zip codes that then allow us as a tracker to go in to your specific loan portfolio and provide to you those borrowers or those pieces of collateral that could be affected during the catastrophe, and also what the state regulations might be on things such as collections, repossessions, or changing payments during that time. So there's a myriad of things that happen during these events that affect lenders and have significant fines that are associated with them, but also recognizing what your exposure is and ensuring that you're doing timely communication to your repossession agents to turn them on or turn them off, depending on the requirements. And then finally, just understanding your borrower footprint and that you as a lender are going to deal with a lot more gap losses and a lot more total losses as the result of a catastrophe. And how are you going to staff up to do that? Or do you need to have a third-party provider available to service that overflow during a catastrophe? Those were all the things, Nick, that are kind of running through my head based on your question.
Yes, and I think Ann, I think you covered all of them. And I think one of your first points, though, about making sure that obviously the customer has insurance in the event of some catastrophic event. You want to make sure that they have insurance, but more importantly, that it covers, those events. Obviously, there have been, over the last year or two, there have been a lot of places that have flooded that traditionally have not flooded, where people don't typically carry flood insurance or those types of things. So I think it's really important to have someone that's not just going to monitor for insurance, but they're going to understand coverage types and severity of loss issues and risk associated to it. So good job there.
Closing moments here of our webinar, Data Due Diligence, a three-pronged approach to proactive risk mitigation. And our special guests for this session have been Jeremiah Wheeler of DRN, as well as Ann Holtzman from Allied Solutions. And to close our session, Jeremiah, we'll begin with you, and Ann, will let you have the last word. A lot of great information you've already shared, and again, please watch your inbox for a link to the recording to be able to review the information again. Just what would you suggest, Jeremiah, and then Ann as well, as a way to manage and ensure that the accuracy of data, perhaps maybe a first step or two that finance companies can take to improve their data usage and cleanliness? As you mentioned in the presentation, a lot of wasted funds and resources have happened through poor data management. Just what would you say is perhaps an initial positive step or two to make to get the process going in the right direction? Jeremiah, for you, and then Ann will give the last word.
Yeah, I think for me, it's looking at historical data. I think that's the safest and easiest way to go back and look at what data you had at your fingertips, what you put out there, what was the result, what were the number of attempts, what were the number of reassignments you had to make on a recovery, what were the number of the average days to repo. Obviously, those are very standard stats, but looking at that holistically across a historical pattern of 1 to 2 years across, start with every vehicle that charged off, and then go back in time and look at how many things could we have had or done differently, or where did we actually end up finding the person in the car, making contact, and which data sets provided the most value there. And once you figure that out, you can, in some cases, eliminate some data sets and some expenses and things like that, and you can streamline things that are working for you But more importantly, I think looking historically is super important for understanding what could really affect your accounts in your organization.
Yeah, Jeremiah, I agree. Historical to me is very critical. I think the other thing is as you're vetting out your service providers as a lender, experience, compliance, and data integrity, I think, are critical. So as you vet them out through the due diligence process, what is their experience? How long have they been mining and gathering the data for the services that they perform? What's that track record look like, and what are their years of experience? And how big's the data set? You know, is it very restrictive and narrow, or is it larger in scope? And is it tied to financial institutions that have the same maybe risk tolerance that you do? But I think it's just very important to understand their compliance, their financial strength, their data integrity, and their experience, so that you're relying on good, credible, regulatorily approved and compliant data.
That's Ann Holtzman of Allied Solutions and Jeremiah Wheeler from DRN. And Jeremiah, thank you so much for sharing great information and recommendations to help finance companies of all sizes.
Thanks everyone for joining.
Yes, thank you.
And on behalf of all of us at Cherokee Media Group, we thank you so very much for joining us. I'm Nick Zulovich, and we look forward to having you again next time.